Hey traders, welcome back to the Price Action Labs YouTube channel, right? So this is going to be a trade recap of an amazingly clean short position you could have taken, right? So this was a short from Monday, the 28th of April, and this was a trade setup we're going to be going over, right? So before I go over the actual trade setup, I want traders to understand how to form a good A plus trade, right? So what do I look for in an A plus trade, right? So there's a couple of things. Let's just take things over to the side. It's really simple when you understand the basics of the market, right? So what you're looking for is you're looking for an accumulation in price. This is typically the Asian range. Now, the Asian range is from 7 p.m. to midnight New York time or Eastern Standard Time, right? So this is your accumulation. Let's label this here as accumulation. Now, once you have an accumulation, you're looking for price to manipulate, and then you're looking for price to distribute off some kind of a fair value gap, right? Most traders understand the basics. But traders often get things mixed up when it comes to knowing what is the manipulation and how do you catch the distribution accurately so you don't enter too early, so you don't FOMO in too late, so you're not risking too much perhaps. How do you get your stop loss correct? How do you get your entries correct, right? So this is where ICT and order flow really come together. And this is what I want traders to understand. If you're trading and you're FOMOing into positions, it is likely because you don't have an idea of liquidity. And liquidity is the backbone of manipulation, right? What does the market manipulate? Well, it manipulates some kind of buy side or sell side liquidity. In this case, it is a buy side liquidity we're looking to manipulate, right? Price is taking out some kind of buy side liquidity. Now, that buy-side liquidity over here is typically my favorite type of liquidity setup. The highest probability liquidity setups you can take is essentially the previous day high sweep, right? So PDH, this stands for previous day high. Now, a previous day high sweep is a very, very powerful liquidity sweep, right? The market will often reverse lower after taking out the liquidity sweeps, right? So for example, if we go over here, this is ES. This is ES now on the 15-minute time frame. Now, I want traders to understand one thing. Going back to our model, this is the previous day high, right? So you want to get a line. You want to draw one line across your chart, right? This is the previous day high from Friday, the 26th of April. So you just want to draw a line like this, and you want to label that line previous day high, right? PDH, right? Previous day high. Now, the previous day high is essentially what you are waiting for. So when price takes out the previous day high, this you can rest assured is a high or a higher probability manipulation. So what you're looking for firstly is your Asian range. The Asian range is an accumulation, right? This is an accumulation of liquidity. We often use it for targets and for our phase 1 and phase 2 manipulations, right? To quickly go over this, our phase 1 manipulation typically occurs of the Asian range low. So when price takes out the Asian range low and then price takes out the Asian range high in line with a previous day high liquidity sweep, this is my A plus setup, because what's happening is price has taken out the Asian range low. Sellers have been enticed, and now we see those sellers being stopped out, and buyers are being enticed. If you can understand Asian range liquidity and previous day high liquidity, your trade setups in terms of your points of interest, your fair value gaps, your breakers, whatever ICT concept you use, it becomes a lot more powerful if you use a simple concept of liquidity. Now, that being said, let's continue to play price on and see what we get. So we end up taking out, price ends up taking out the previous day high, and we have a very, very large manipulation move over here. Now, this is where things become very interesting. We can head down to the lower time frames at this stage. So if you're struggling as a trader, I want you to remember a couple of things. Remember, only go down to the lower time frames after price has taken out some kind of major liquidity. In this video, we're going to be focusing on the previous day high, because what happens with manipulations is you want to see price come up, take out some liquidity before breaking structure to the downside, right? This here is a previous day high manipulation. So I want traders to understand an ICT Judas swing is just a sweep of the previous day high. Now for me, we go down to the 5-minute time frame. Now on the 5-minute time frame, there's a couple of things I look for after our initial liquidity sweep, right? So let's first get that here. Now, once you've had a liquidity sweep, what you are looking for now is you're looking for a 5-minute imbalance, right? And you're looking for a 5-minute imbalance that's above the 10 a.m. Eastern. So this is where the power of 3 becomes very, very important. So what's happening is if we just kind of draw a little schematic over here, we see price heading higher. We see price heading higher, taking out liquidity, breaking structure, and now we have a fair value gap over here, right? So we have a 5-minute fair value gap. So I'm just going to label that in blue. So this is the 5-minute imbalance over here. Right, let's label that in blue. What does an imbalance tell you? Well, an imbalance tells you that the price action has delivered in an unfair fashion. There's an imbalance between the total number of buyers and sellers at this key level. Now, notice how I use the word key level. All of my trades are at key levels, and I often get questions every single day. How do I form my supply zones? How do I form my demand zones? How do I know where to trade from and where those high probability trades will come? Well, it's a good question. So there's a few things I use to determine my entries, right? To determine my overall POI selection guide, right? I use the power of three heavily. And when I say power of three, I like to use the 10 a.m. power of three because I'm more of a scalper on ES. You can apply this to NQ. However, you can also use the daily PO3. So I do use the daily PO3. The daily PO3 becomes very powerful if you're swing trading. So for example, if you see price significantly above the daily opening price, you can hold that trade. You can almost, not swing trade it, but you can almost intraday trade it back down to the daily opening price. I'll show you that later in the video. So I like to use the PO3, daily and 4-hour PO3, right? I also like to use basic market structure shifts, right? So what do I mean by that? We can see here price has given us a fairly basic market structure shift, right? Notice how we've broken with the body as well. That's our market structure shift, right? The next thing I look for in trades is I like to see price giving us, of course, we're above the 10 a.m. Eastern, we have a market structure shift. I want to see price give a fair value gap. And the fair value gap is the most important thing, right? We can see price leaving a fair value gap. So if you don't have a fair value gap, that is not a key level, and therefore any trades you take from there are invalid. So the losses are your fault, not the market's. That's important to understand. And also the last thing, going back to one of my previous points, you would like to see a fair value gap after a major sweep of liquidity. So in this case, we see a previous day high sweep, right? Going back to our previous point. So previous day high, very important to understand. So we have that previous day high sweep over here. This is my checklist when it comes to forming A plus POIs, A plus supply zones in this case, A plus order blocks, AOIs, whatever you want to call them, right? You need to know where to trade from. And this leads on to one of my other points, is the framework. Every trade you take has to follow a simple framework. You need to know where to trade from. The where is very important. You need to know what to look for, right? And you also need to know why you are looking for it. Why are you going to buy? Why are you going to sell, right? Most traders get number 3 wrong, and we're going to understand why number 3 needs to be spot on. So this is the 3W framework, I call it, right? The 3W framework. Now from here, what's going on in price? Let's kind of zoom in. So when price comes into this fair value gap, what you are looking for is you are looking for how price behaves in this area. So you want to see the rejections from this area. You want to see the rejections of this area. So overall, what you need to understand is price action will behave in a certain way over here. Notice how we're above the 10 a.m. Eastern, right? This is important to understand. Now, we know that we're above the 10 a.m. Eastern, so we know where to trade from. We have our blue zone, our fair value gap. Now we need to know what to look for. Now, what are you looking for? This is the question that stumps everyone every time I ask them, right? This is the ATAS platform. I get lots of questions in the short form content. Let's just go over this right now. This is the ATAS platform. I use it to trade every single day. You can execute trades from it. It is the most accurate platform you can use when it comes to actually trading properly. Let me give you my settings of the ATAS platform. Now we go to cluster settings, and on the cluster settings, you have access to the bid and the ask, right? Aggressive sellers versus aggressive buyers. You also have the delta. Now, the delta is the difference between the ask and the bid, right? And the delta is probably the one thing that is holding you back from trading ICT concepts or just any concepts properly, right? So once you have the delta in place, your job is to simply mark out the fair value gap, right? So the fair value gap is exactly the same as what you saw in the charts earlier. So the question is, why did we get the rejection off here? Why did the market actually reject, right? Why was this fair value gap valid? So we're above the 10 a.m. Eastern. We've taken out previous day high. So we know we know where we're looking for trades. We know what we're looking for. Now we need to understand, why did the market go down and why are you looking to sell, right? So the reason we're looking to sell, if we just zoom into these candles, what you need to understand firstly is the high of day, which was up here. Now, this high of day was very, very interesting, right? What did you see in this high of day? Without even reading the numbers, you can see a ton of blue delta over here and a lot of blue delta. So the candle itself was red, but we see a huge amount of aggressive buyers at the top. Now, this corresponds to this candle over here. So this was the high of the day. So this high of day corresponds to where the previous day high was swept. Now, you can see so many buyers in this region. Those buyers are trying to drive price higher. The reason you see buyers over here is because we can see the blue delta. In fact, you only need to read one row to understand this. We see 500 for 1,000. 529 for 1,000. That's almost a 1 to 2 in terms of there were double the amount of aggressive buyers than there were aggressive sellers. Despite that, the market closed bearish and we broke structure to the downside. So you want to ask yourself, in this region, buyers stepped into the market, but those buyers failed, right? That automatically gives you indication that that this area is a strong area to be selling from because aggressive buyers have failed, which means passive buyers are present at this level. And this is what I want traders to understand. The reason this sell trade worked out isn't because of a market structure shift, a fair value gap, a PO3, or any indicator. These things are all confluences. But the actual reason the market moves up, or in this case, the market moves down, is because there were passive sellers sitting here. Now, these passive sellers are what moves the market, right? Passive sellers drive price lower, passive buyers drive price higher. Now, we see passive buyers resting over here in this region. We also see them resting at this fair value gap. So the reason this fair value gap is valid is because we know why the market moved down. And the reason the market moved down is because there were more passive sellers than aggressive buyers. Let me repeat that. There were more passive sellers than aggressive buyers. There were not more buyers than sellers. That's incorrect, right? There's always a one buyer and a one seller. There were more passive sellers that were driving price down. And the reason we know that is because if we look at some of the numbers we see over here, we see 396 for 629. We also see a bunch of zeros here over here. We see 163 for 363, and our final rejection over here before the market melted down. So what we can see is we can see a lot of buyers failing in this region. We see a lot of buyers failing in this region. We also see a lot of buyers failing in this region, right? So we see a lot of aggressive buyers at the top, but none of them were able to significantly break above the fair value gap. And so this is the reason the trade actually held in the first place, right? Because over here, we had a lot of aggressive buyers. Now, when the aggressive buyers fail, that means that sellers are in control. Passive sellers are in control. And that's what makes the trade valid. So you can have a stop loss kind of around this area where the fair value gap isn't. And the next question becomes, well, where do you target, right? Targets are obviously a very controversial topic in trading. They shouldn't be. Right? Targets are people hold to the moon, people hold forever, and that's why they end up taking break-evens, getting stopped out, right? Small base wins hit up. But in this case, we have a lot of liquidity from London, right? London session leaves a ton of liquidity. London session left a fair value gap over here. London session also left the London low, right? So we can basically target any one of these areas. So you have basically three targets, right? So I often like to hold full volume to the first target, which is going to be down here. That's a 1 to 2.5